Aloha everyone, Jason Wong here with Island Dragonfly. Let's talk about everyone's favorite subject. No, not the surf report, not the tuna freshness rankings. We are talking about taxes, specifically the Hawaii Conveyance Tax. I know. Try to contain your excitement. But if you are selling property in Hawaii or buying it, you need to listen up because this is literally the government's cover charge for the party that is your real estate transaction. So, what is it? The conveyance tax is a one-time transfer tax imposed on the transfer of real property. It applies to deeds, leases that are 5 years or longer, and other instruments of transfer. Now, here is the million-dollar question. Who pays it? In the vast majority of transactions, the seller pays the conveyance tax. And here is where it gets a little sassy. And by sassy, I mean expensive, while you, the seller, are the one writing the check. The amount of that check depends entirely on the buyer. That is right. You are financially responsible for the buyer's life choices. The state of Hawaii has a two-tiered rate schedule based on one simple question. Is the buyer eligible for a county homeowner's exemption? Basically, are they going to live there as their primary residence? If the answer is yes, the buyer is an owner-occupant. The seller pays a lower tax rate. Mahalo, buyer. If the answer is no, meaning the buyer is an investor, it's a second home, or they just aren't filing that exemption, the seller pays a higher tax rate, sometimes significantly higher. Let's dive into the numbers because I'm an MBA and I love a good spreadsheet. The tax is calculated for every $100 of the consideration. That's fancy talk for the purchase price. Scenario 1. The buyer is an owner-occupant. The rates start at 10 cents per $100 for properties under $600,000. They scale up progressively. If you sell a luxury estate for over $10 million to someone living in it, you are capped at $1 per $100. That is a 1% tax. Scenario 2. The buyer is not an owner-occupant. This is the investor scale. The rates start higher at 15 cents per $100. And if you sell that same $10 million plus luxury estate to an investor, the rate jumps to $1.25 per $100. That is a 25% increase in your tax bill just because the buyer has a different plan for the house. Let's do a quick real-world example. Say you are selling a home for $2 million. If your buyer is going to live there, your rate is 30 cents per hundred. Your tax bill is roughly $6,000. If your buyer is an investor, your rate bumps up to 40 cents per hundred. Your tax bill is now $8,000. That is a $2,000 difference. That's a lot of loco moco plates. This is why when we are negotiating offers at Island Dragonfly, we look closely at the contract. We need to know the buyer's intent because it directly affects your net proceeds. Now, are there exemptions? Of course, it's the government. There is always fine print if you are transferring property between spouses or between a parent and child. Or if the consideration is nominal, under $100, you might be exempt. You will file what is called a Form P-64B to claim that exemption. For everyone else paying the tax, we file Form P-64A. And yes, these forms are mandatory. The Bureau of Conveyances will not record your deed without them. Look, the Hawaii Conveyance Tax is nuanced. The rates are graduated, the brackets are specific, and the math can get tricky. You do not want to be surprised by this line item on your closing statement. That is why you hire a professional who understands the luxury market and the tax implications that come with it. If you want to navigate Hawaii real estate without the headaches, let's connect. I'm Jason Wong. I handle the math, so you can handle the move. Aloha.